welcome everyone. Good morning or good noon if you're on your lunch break, if you're on the East Coast. I'm in San Francisco, Shakti's in Dallas, Stacy's in Hawaii, so we're all over the place. We are really excited. You know, there's a lot of stuff going on in the world today, especially in the US with markets changing. And so we're always looking for great deals for our investors. And Ashland Green got this deal under contract, and Chuck's going to tell us the story about how they got it under contract. We're going to go over it with you. But it's been harder and harder to get good deals under contract because we're being more and more conservative in our underwriting, in our assumptions, much tighter and more conservative. And so we're going to share with you, what Ashland Green and SuGo have been looking at and what we found. But I wanted to share that right out of the gate, that we're being more conservative because we've seen that assumptions of even a year ago, 2-3 years ago, don't necessarily hold anymore. So we'll walk through that with you guys. And we are recording this. The recording will be sent out today. As soon as Zoom produces it, we'll send you the link so you can share it with anyone you make your financial decisions with. So it's not a private link. It's not a private investment. This is open to accredited investors. So you can share it with friends and family who you think would benefit from this investment, your CPA, your attorney, your spouse, whoever you make these joint decisions with. Please feel free to share it. We like everyone you make your financial decisions with to be in the know. And we have an hour. And so Ashland Green has a presentation that is 63 slides. I got it down to like 50 slides, so I took some out. But there's a lot of information.
And we know that people like that information, and we know that's one of our competitive advantages across kind of the competition. But I know it's not everyone wants all 100 or 70 slides, but we always do a pretty good job in 45 minutes boiling it down to just the most salient points. And then if they want, they can look at the detail later. Exactly
where I was going. So you'll see in the presentation that the page numbers don't follow each other because I chopped up the full presentation. So warning, it may be in a different order, the different slides. However, the full presentation is in the investment data room. So if you guys go to investwithsarah.com, that's where you can begin getting access to the data room, and the full presentation is in there. So, when we go over underwriting and there's like a million numbers and we might spend a minute on it and you want to go back through those numbers, all of the information is in the data room. It'll be there for you guys to access whenever you want. And again, you can share that information with folks you make your decisions with. All right, with that, I'll introduce the people on the screen. So Stacy Spencer is on the SuGo team, SuGo Investor Relations. So a lot of people, I'm Sarah Sullivan, she's Stacy Spencer. Sometimes people email me, hi Stacy, or email Stacy, hi Sarah. Similar names, but different people. So I want you to know Stacy's face so that when you're looking to sign your documents, ask your questions, get your wire instructions, all of that, Stacy's the person who you'll be contacting and in connection with. And it's so great to have her on here. Stacy, if you want to introduce yourself in 1 minute or less, that would be great.
Okay, great. Well, hi, everyone. I actually was an investor with Sarah first. So just so you know, I was an investor with Sarah for a couple of years before I joined her team. And then I thought this would be fun working with other investors. And I said, I would work with Sarah. And 3 days later, Sarah sent an email saying, I'm growing my team. And I turned that shaka into a call me. And here we are.
Yeah, and it's awesome because Stacy knows all of our investments and our investment style. So if you guys have any questions, feel free to reach out. She's been investing with us. And she's been with us since we've been doing all our projects with Ashland Green, so she knows our partnerships really well as well. Thanks, Stacy. All right, and the other person you see on the screen is Shakti. He is the owner-founder of Ashland Green. And Shakti, why don't you introduce yourself before we jump in?
Yeah, so been in the real estate space for since 2008. Before that, I was in finance on Wall Street at Lehman Brothers and then a private equity fund in New York. Started investing in single family and small 3 and 4 unit multifamily in New York. And then in 2017, pivoted to raising capital from outside investors many of whom I had known for, almost 10 years back in New York. And they said that if I ever opened up investing to friends and family, to call them. So I did that, and I raised money for our first deal in 2017 here in Dallas, Texas, about 180 unit apartment complex, not too far from one of the ones you own, Sarah, out in Denton. And then subsequently moved here in 19, started a property management company and vertically integrated our construction and property management with our capital side in 2020 during COVID, took over 6 or 7 very challenging assets that we owned here in the Metroplex at that time. And kind of the roots of our company are in turning around distressed assets that are really, really challenging to turn around. And this is not one of those assets, the one that we're going to be looking at today, but we've acquired a little over 6,500 units. We've sold about 1,000. So we've had about 6 exits, averaging around a 28% average annual return for our investors. And we are just local in Dallas, and we only own and operate assets here in the Metroplex. So I'm sitting here in Uptown at our office. I live about 15 minutes from here, and we can get to any one of our assets within 45 minutes drive with traffic in Dallas, maybe an hour. And so that's one of the reasons that Sarah and Stacy, continue to, enjoy working with us, because of our local boots on the ground expertise. And we've had a great relationship with you guys. So thank you to your support over the last several years, and for the investors, looking forward to sharing this opportunity with you guys this morning.
Awesome, thanks. All right, I'm going to go ahead and start sharing my screen. We'll get into the presentation, and Stacy, I'll invite you back in the end when we talk about next steps.
Sounds good.
All right, so the name of the property currently is West Creek Ranch, and it's in McKinney, Texas. So we'll go over, we're going to start, the way that I teach due diligence is first to do due diligence on the team, make sure that you're aligned with their values, the asset class that they are an expert in, and then do due diligence on the market, if it's in real estate, or even if it's, a different asset class, really make sure that that asset is aligned with what you're looking to do. And then finally on the property. So we're going to follow that order mostly here. And like I said, for those of you who just joined, this presentation is bits and pieces of the full investor deck. So to see the full investor deck, if you go to investwithsarah.com, you can get access to the data room, and the full deck is there. All right, disclaimer. You can lose money in any investment. That'll summarize what's on the screen. Anything more detailed you want to say about the disclaimer, Shakti?
Nope, that sounds about right.
Cool. So again, this is the table of contents, but we're not going to go through every single page, but just wanted you to know all this detail is in the data room. So a lot of people said, sometimes I have to wait till the end to see if this is aligned with what I'm looking to do. So I wanted to start with, what are their returns? What is this at a high level? Actually, this is not the slide that I wanted, but we'll go with it. So there's a new investor class. So I wanted to say, we heard you. A lot of people were saying, hey, we're strapped for cash flow. A lot of our investments that were providing us cash flow are not providing us cash flow right now. So in this investment, there's 2 ways you can invest. One is a class A, and so you get cash flow. So it's 10% a year. It's paid quarterly. And that's an investment between 100 and 200. And then we also have class B and C, which are regular, like you've seen, where there's some cash flow along the way, but mostly you're investing for the equity upside. It is for accredited investors, and it is a 5-year hold. So that's the high level. If that works for you, keep listening. And here we go. So Shakti introduced himself already. I think everyone on here knows me. In case you were invited here and you don't know me, SuGo Capital opened up in 2019. And since then, we have acquired over, it's close to about 9,000 doors. And this is what it looks like. And you can kind of see in Dallas, I started grouping everything as AG portfolio, because now it's, with this acquisition, will be over 1,000. It was getting kind of crowded. So we got to figure out how to represent it differently. But this is our portfolio. You'll notice I said I live in California. I live in San Francisco, but we don't have anything in California. So we specifically invest in landlord-friendly states, and states that have a growing population where people are moving to, which is not California, especially right now. And so we have a lot in Texas and then across the Sun Belt. And you can see we have had 6 exits. And oh, hi, Lacey. And the rest we still own. So with that, you might see some of the properties that you're in. They're on this map. Now let's jump more into Ashland Green. So I started working with Ashland Green personally in 2022. I invested with them. And what you're about to see, I'm going to ask Shakti to go through it, but I'm going to comment on it, that they have a lot in their slide deck about their culture. And I want to let you know, I found it to be 100% true. And that's why I continue to invest with them personally. So I'll show you on their track record. There's the property that they acquired in September 2022. I've been in every property since then with them, both personally and partnered on the GP side, bringing in our SuGo Capital community of investors. And so I'm just totally impressed by their professionalism, the culture that they've developed for not only their employees, but their properties as well, and for the investors. So I'm going to ask Shakti to go through some of that. And it might seem like fluff, but it's actually very, very important. As an investor, you want to know these things about the team. All right, Shakti, I'll let you take this. I think this is actually really nice.
Okay, yeah. So, I mean, first thing you should probably know about our company is kind of why do we exist and who do we exist for? And there's 4 main constituencies: our investors, like Sarah, Stacy, and yourselves; our employees. We have 170 employees here at the company between the corporate office, which has about 45, and 120 or so out at the various 20 communities that we own here in Dallas; our residents, which are around 11,000 people, and then obviously all the various communities. And the underlying mission across, while we're serving all of these different constituencies, is to make a positive social impact in the communities where we own and operate. So that's kind of the mission statement. And this is how we execute on that mission statement. And it's through our core values. The acronym is RAISE. So the 5 letters stand for respect, accountability, integrity, service, and excellence. And what we like to say around here is that at Ashland Green, we raise the bar for ourselves and each other. So whether it's interacting with our investor relations team or employees at the site level, interacting with vendors, everyone that interacts with our company should experience these 5 letters in their interactions with our team.
And I have 100% experienced this in working with Ashland Green. And I would love it because I see a lot of names in the audience. So if you guys have worked with Ashland Green, I would love for you to put in the chat professional if you've experienced their investor relations team, communication, monthly communication, quarterly webinars, and all of that to be professional. Please put in the chat the word professional, because I really haven't experienced such a great investor relations team with another group that I've worked with. Yep, so I see those words popping up. So there you go. And this is one of the reasons I think you guys are so successful. And when we talk about the timeline of the CapEx plan and the value add plan, we'll tie this in. But why don't you explain this?
Yeah, so we have 3 vertically integrated companies, and then we also have a 501c3, which is called Ashland Green Impact. That's our corporate philanthropic arm that my wife, Sheetal, is the chief impact officer. But we have Ashland Green, which is Ashland Green Capital, Ashland Green Living, AG Living, which is our property management company, and Ashland Green Construction. And then we also have Impact. So that all rolls up into the umbrella company, which is Ashland Green. As I mentioned, to date, we've acquired almost 7,000 units. We've exited a little over 1,000. Currently, we have about $1.2 billion of assets under management, of which it's around $275 million of equity, and the rest is debt. So being vertically integrated gives us control over the life cycle of the investment. We don't have to depend on a third-party property management company or a construction vendor. We are our own GC. We select subs in the market that find that our scale is advantageous for their independent growth. So we like to kind of leverage the fact that we have so many units in one market to get us the best pricing on the property management side, also the construction management side. And it gives us a ton of leverage when we're negotiating deals like the one that we're presenting with you guys today, because we're able to move so quickly because we're only managing a small number of relationships in one market.
Yeah, it's really awesome. Awards and recognition, you guys can look at this later in detail, but they're recognized by their peers and in the industry. So that's awesome. 4 T's of investing. Can you go through this? Because especially right now with what's going on in the United States, I think this is really important, how you guys, put this forward facing to your investors and to your employees.
Yeah, so it's basically, Sarah, what you said at the beginning of the webinar, which is you kind of look for the jockey first, i.e., who is the sponsor? Do you trust them? Do you want to put your money with them? When you put your money with them, do they communicate with you transparently, not just when things are going well, but how quickly are they telling you that things are not going as according to plan? What does their team look like? It's certainly not just me. There's a whole roster of people here at Ashland Green that manage these assets, execute on the business plan, and help distribute capital back to our investors. I provide the vision. What I like to say is inspire, teach, train, and coach. That's my job. And I hope we have a brilliant executive team that I believe is the team that's going to take us to 30,000 units. Obviously our track record speaks for itself. And I think these 4 T's is, if you're an investor and you're considering an investment, these are the 4 boxes that you want to check off at the top of your list, like Sarah said.
100%. And speaking of the track record, here it is, you guys, everything. And one day I'm going to get my track record as organized in one slide as this. I just borrow your slide.
You can definitely do that.
Yeah. So if you guys look at the last column, acquisition date, this is the date that the properties were acquired. So if you kind of scroll down until you find 922 with Fiona Apartments, that's the first project that I partnered with Ashland Green on, and then everything else down that line we've partnered on. And it's been a really, really nice experience, really professional, and you'll see why. It's not a couple people. I'll show you slides of the whole team. It's a very nice team. And then you can see for the projects that they have exited, 28, 29% annualized returns as their actual annualized returns for their investors at exit. So that's a really nice track record, and they're doing a great job of continuing that for you guys. All right, so like I said, I'll just go through this quickly, but I wanted you to see the scope of professionalism of their team. There's not just one slide, not just 2 slides, but 3 slides. And then, as Shakti said, there's people who are at site and vendors that support as well. All right, so let's jump into the actual financial analysis. What is this project? So like I said, this is West Creek Ranch, and it's in McKinney. I went, let's see, it was 2 weekends ago now, maybe 3 weekends ago. I went out there, and Alok, who's the head of investor relations at Ashland Green, he took me out. We went around McKinney. We looked at the property, and I was kind of confused. I was like, it's so nice. How are we going to do a value add? It already looks fabulous. The deferred maintenance was like zilch. I mean, there's definitely some things to be done to make it prettier. But really it's in such great condition, and the market's great. So we'll talk about both of those things. One of the things that I love most is the location. So if you see on line 4 on the right-hand side where it says property location class, so it's a B property in an A- area. And so if you guys invest in single family homes, you probably know this rule that you don't want to be the nicest house on the block. You want to be the medium nice house on the block so that you appreciate with everyone else, right? Like the location is super important. And so the location is an A-, the schools are A-. It's just a really, really great area, really great tenant base that's available for this property after the value add. So, a lot of times there's a value add and it's like, okay, well, you can make it really nice, but if everyone can only pay $1,000 for rent, you can't raise the rent to $1,200. And so having that tenant base that wants a nicer apartment, that wants a nicer community is essential if you're doing value add apartments. So like I said, the hold period is 5 years. $45 million purchase price. Shakti, can you talk a little bit about how you guys found this property and how you got it at the price you did? When we talk about comps later, we'll see that this was under market value if you compare it to sales that happened in the last 6 to 12 months.
Yeah, so I mean, one of the things about being here in Texas locally is you're known, I guess, across the brokerage community and then with sellers as well. I happen to play a lot of tennis. I was a competitive junior tennis player in Southern California. I was ranked in the top 100 in the 16 and unders. And so I've kind of continued playing tennis, and it's not as good weather here in Texas as it is in California, but it's much better than in New York. So I found out that the seller of this property owns about 40,000 units. He's a pretty prolific investor, and he's very well known here in Dallas and across the Sun Belt. And I got his email about a year ago, and he also was a competitive junior tennis player. He's about my age, early 40s. Anyways, we started playing tennis together about a year ago, and we played tennis a couple months ago, and he mentioned this deal to me. And I said, well, yeah, why don't you send it over? And so within 48 hours, we had the deal underwritten. I think I was on a ski trip or something on that Friday, and I told him I'd call him on Monday. And he's like, this is the price I want, $45 million. If you can make it work, great. And we underwrote it. We reviewed it at investment committee on Monday afternoon. I called him Monday night, less than a week after we had that tennis game. And I told him, you know what, Dave, this is exactly the type of property we're looking for. It's off market, direct with the seller. It has a low basis relative to the comps. We're very, very location sensitive. Sarah mentioned conservative underwriting at the beginning of her webinar, but we're slowly migrating. As for those of you that were with us last year, you could see that we bought a early 2000s vintage in November in Valley Ranch, which is one of the top school districts, the Capel schools. We bought another one, which is 2007 vintage. So we're sort of migrating. It's a little bit of a flight to quality for our portfolio. We predominantly own 80s. So this is a newer deal in the path of progress. So kind of heading north and east from Dallas. So Frisco, Salina, Prosper is kind of like north along the tollway. And then McKinney, Anna, Melissa is sort of north on 75. So this is in the path of progress. There's been a tremendous amount population growth, 325% population growth in the last 20 years. Money Magazine rated McKinney the #1 place to live in 2014, which is about 10 years ago. Great median income, 78,000, great median home prices, and tons of value creation. This seller actually bought this property in 2012. So kind of a little bit early on before the market really exploded, and didn't really do any renovations, just bought it at a great price, did a few renovations, but out of the 240 units, there's 226 that haven't been renovated. So just a huge amount of upside. So we feel really good about putting in $5.9 million into this project and still being able to qualify our tenants for rent. And if you look at the cap rate, I'll leave this slide with this, is the cap rate's a 5.5% tax adjusted and insurance adjusted cap rate, which is what you see for maybe 1980s deals. And this is a late 1999 in McKinney. So we really feel good about the existing condition of the asset from day one as we take over. So it's a little bit about the property and how we found it and why we like it.
Yeah, I love it. That's how we love to get deals. Not something that's on the market that everyone's upbidding each other. So this is great. And it happened to be a great property. And with that, we'll jump into some pictures. So this is what it currently looks like. It is when I was walking around it, I was like, it really, really has a good community feel. It has a nice flow. Sometimes apartment complexes that are garden style, it's kind of like an awkward flow. You get lost, it was a really nice community feel. And this is the kind of current classic, and then how Ashland Green is going to make it nicer. So when Alec and I were looking, I was like, it looks pretty nice. And then he said, well, let me show you one that's actually already been done. So this is the one on the left is the current classic that we were looking at. And I was like, I don't know, it seems pretty nice. But then he showed me the upgraded one where they knock out and make it more open in the kitchen. And I'm there with my hand up to show you how tall the ceilings are, and that really made a difference. So a lot of apartment buildings, you know, they have kind of like low ceilings. This has a really high ceiling, so it feels really open, lots of potential to make it feel pretty, you know, nicer than other apartments do.
Yeah, and you go back to
Yeah.
that picture real quick. See,
Yeah.
you can also see that Alok, his hand is on that wall, which the seller removed, and lowered the countertop. So it kind of pairs really well with those 9-foot ceilings
Yeah.
that these late 90s deals have, and it makes it look much more modern, and new. And now, just to be clear here, guys, out of the 240 units, the current seller did 14 units in a very similar style to what Ashland Green calls their diamond. So the picture that Sarah is in is actually the exact unit, same floor plan as what Alok is in on the left-hand side, and that's the current seller's renovation. So we're not going to touch those 14 units, but we're going to do the other 226 units to look exactly like the unit that Sarah's standing in there on the right-hand side.
For clarification, thank you. And again, this is just how pretty it's going to look at the different apartments. Okay, so let's jump into the numbers. So like I said at the beginning, if you want to invest for equity, you can. If you want to invest for cash flow, you can. So there is about 4 million available. That's Class A. And so that's when you invest 100 to 200 in Class A, you get that 10% cash flow per year. There's no participation in the equity upside. There's no bonus depreciation. So it's similar to a debt investment in you know how it feels. And then you can also, so this is what it would look like, a 200K investment, 10% a year, so it'd be 20,000 per year. And then at the exit, you would get your 200K back, but no equity upside. And then if you invest in Class B or Class C, it's the normal how you've been investing with us, where you get some cash on cash, but most of what you're investing for is the equity upside. So something key to know is that you see the year one depreciation is lower than you've seen in the past, especially with Ashland Green. And that's not because of Ashland Green. That's because of you know, the IRS saying, oh, we're going to change the way that you can, how much of the bonus depreciation you can use, but it is under review that maybe they'll bring back 100. So I want to point out this number may be different depending on how the vote goes. It had nothing to do with Ashland Green or this property. So for the Class B and Class C, there's a preferred return. And so know that the preferred return is not the total expected return. It's not the cash flow. But if you invest 250K or more, you get a higher preferred return, and it's 16%. So what that means is if you invest 250,000 or more in this property, in this investment, you will receive a 16% annualized return before the GP team, so Ashland Green and SuGo, receive any money. And so after that, we split the profits 50-50. And so that aligns our interests with yours. We don't get paid unless you get 16% a year first. So, you know, you should take that as a very, very strong vote of confidence in the management team in this property. If you invest less than 250K, then you would be a Class C investor, and you would still get 12% preferred return, which I have not even seen 12% out there besides my other investments. And so that means that you as the investor will receive a 12% preferred return before the GP takes any profits. And after that 12%, we split profits 50-50. Any questions on this? This is really important to understand before we go on. Okay, so Brady has a question on the Class A. He said similar to debt, but does that mean it's not secured debt? Correct. Class A, correct me if I'm wrong, Shakti, Class A is not debt. It's preferred equity, but it's not actually debt.
Yeah, that's correct. And it is senior to the B and C class. So the Class A only has about $3 million of available in this, because that's where we can still size to a 1.25 coverage ratio, if that means anything for the investors. So we size the Class A to go right behind the senior. So the senior gets paid first, and then the Class A investors, they get that 10% of the 3 million. And then the remaining 18 million or so goes to the Bs and Cs. So it is a priority position. Those investors in the Class A will receive a 1099 INT. So it's basically like it functions very much like debt.
Okay, cool. Thank you for that. So Xavier, yes, Class A paid quarterly at 10%. Is that interest only? Correct. So if you put in 100,000 and you get 10% a year, you get $10,000 that year. And then at the end of the investment, you get your $100,000 back. So it's an interest only payment. Brady's asking, is the profit split the same for B and C? The only difference is preferred rate? Yes.
Yes.
12%.
And yeah, that's right. Correct. So the returns are a little bit higher on the B because of that. The split doesn't occur until after a 16.
Correct. 12% return of what? Of the amount invested. Yes, correct. I think maybe the other slide will bring clarity to most of these other questions. So if you're Class B or Class C, so let's do Class B first. So say you invest 250,000. For the first 2 years, there's no cash flow. And then year 3 and on, it's 7% or more cash on cash. And then at the exit, you can see the gain on sale is estimated to be around 183,000. And so your total return would be roughly doubling your money. So over 500,000. So that takes into account the cash flow that you can see years 0 through 5, the gain on sale that you receive at the exit, your principal return of your 250K. And so if you add that all up, it's over $500,000. So that's roughly doubling your money in those 5 years in the form of some cash flow starting in year 3 and mostly in the form of capital gains that you receive at the exit. And then you can see for Class C down below, and the example is $100,000 investment. So same thing, there's no cash flow for the first 2 years, and then it starts ramping up in year 3. And the gain on sale will be a little bit less, but you can see it's still pretty close to doubling your money in 5 years, closer to 18-19% annualized instead of the 20%. So now that we've explained that, I'm going to run through the questions to see if any of them were not answered by that. Yeah, there's some questions on the loan. So the key investment highlights that we were on before, Leah, you'll be able to, I'll just show it real quick, but you guys can access it. Oh, it's quite a ways back. This one has information on the debt. So Shakti, do you want to just talk about that? Because I see about 4 questions on, yeah, but what about the debt? Can you talk about the senior loan here?
Yeah, so since we're going to be renovating 226 units, guys, we're going to be putting in $5.7 million. And so even though we like the going in cap rate at 5.5%, we like the doing a bridge loan where we can finance the CapEx as well as about 70% of the purchase price. So it's a $37 million senior loan. It's going to be a bridge loan, and we're going to be buying a 1% strike for our rate cap. So our all-in blended rate should be about 4.5%. We're purchasing a 2-year rate cap up front, and we're going to be escrowing at closing and through cash flows as well for the next rate cap. Our intention here on the loan, just to be clear, is to get through the business plan and at the end of year 3, refinance from the bridge loan instead of using the extension into an agency loan. We don't put that in the underwriting because it's speculative, but we've done it with several assets in our portfolio. We're going through one right now. And you use the bridge loan to kind of get through the value creation. And once the value has been created, you can refi to a fixed agency loan. So that's the plan on this asset here.
Cool, thank you for that detail. All right, I'm going to jump back because there are other slew of questions about Class A. So people are asking, is there any equity share with Class A? There is not. Is there any depreciation share with Class A? There is not. Someone says, so since it's limited, if I want to be Class A, do I need to hurry and commit? Sue, I would say yes. A lot of people are really, really interested in cash flow. So how do you do that? You go to investwithsarah.com, and that's the beginning of the commitment process. That'll take you into the investor portal. So you can put in your commit there and it'll take you through the signature process and seeing all the documents. All right. I'm reading all the questions. Some are duplicates. Guys, go ahead and put your questions to everyone so that you can see if it's already being asked. Okay, the rest seem to be about Class B and C. So Class C will get 12% after 5 years and what percent of equity profit? So Class C will get 12% per year and then 50% of equity profit. Class B will get a preferred return, meaning if the property can support it, let me preface it with that, then the Class B will get 16% annualized. So each year, not just in total for the 5 years, but 16% per year that we're in the property, and then 50% of the equity profit after that. So
Yeah, I'll just jump in, Sarah, and say that in addition to returning after that 16% annually or the 12% annually gets returned, if you're a B or C investor, you get all your principal back. So if you put $100,000 in and you're a Class C investor, we hold for 5 years, you get 12% times 5 years, which is what, 60. So you get 60% return on your 100 grand. So you get $60,000. Okay. And then you get the $100,000 you invested back. So you get 160,000 if you're a Class C investor. And then whatever profit is remaining is split 50% between the Class C investor and then the GP. So that's what gets you to that 1.92 equity multiple. And then you can use the same math if you do Class B. I won't do it now, but it's the same math for Class B. It's that 16% annually plus the initial principal investment and then 50-50 on all the profit.
The Tim is asking, so 16 is the average preferred return, but nothing in the first 2 years. Correct. So it's not 16% cash flow, but it's at the exit, making sure that, Tim, you would get so if you invested $250K or more, we would make sure that you receive 16% per year at the exit, and then your principal return before we start splitting profits. Fidel asking, how soon will the cash flow start after the investment? So take a look on the screen. Cash flow will start in year 3 for Class B and C. For the Class A investors, it starts right away. So if you're a cash flow investor, Class A, then you would cash flow right away. If you're an equity investor, in year 3. Then someone's saying this is a good point. Gary, he said, I've seen other sponsors who do like a 70-30 instead of a 50-50. Why so high? Well, those other sponsors normally don't have a preferred return, or they have like a 4 to 6% preferred return. So if you see someone who has a 70-30 split and a 16% preferred return, that's pretty cool. I'd like to see that, that investment. But in my mind, I think it's very generous to have that high preferred return and then allowing the equity split. It definitely aligns incentives. Now, there's another question, and we'll get to it later, Mike, not today, but this is a really, really good question, Mike. And so everyone, when we have this number, we'll send it out. Mike is asking, how much are all the sponsors putting in? And we haven't totaled that up. I haven't decided how much I'm putting in. I don't know if everyone on your team has decided, Shakti, but as we get further into the investment and we have that number, we will definitely share it.
Yeah, and I'll just share this with the group now for everyone's edification. One of the unique things about us here at Ashland Green is I personally am the largest investor in all 20 assets. So I don't just buy the deals, put them together, bring investor money and sell them and hope to make some money along the way. I actually put in the most money on all the deals. So currently the largest investor, I probably will be in the Class B, so 250K or more. I've always been in the Class A or the Class B, so this probably will be no different. We generally like to target around 5% to 10% of the total equity being brought by the sponsors. So this should be no different in this deal. That's the target. But like Sarah said, when we finalize the actual allocations, we can share that with the group.
Yeah, it's a good question, Mike. So for instance, in this deal, the raise is about 20 million. So then 5 to 10% will be 1 to 2 million. So we'll be in that range altogether. Some questions about investing with retirement money. I see several, and yes. So when you go to investwithsarah.com, there's a drop down and it says, how do you want to invest? So you can select IRA, you can select 401k. I'll walk you guys through that in a minute, but you can do that. Sue has a question about discounting. Sue, why don't you contact hello@sugocapital.com and Stacy can work with you on that. All right. A lot of really detailed questions on the returns. I'm seeing if I can read them all and then summarize them. All right, so some people are asking year 3, 4, and 5 cash flow for B and C. Is that considered capital gains for tax purposes? The gain on sale line is considered capital gains. The cash flow is not considered capital gains. Yes, Ken, this is a great question, Ken. Is it possible to invest in more than one class at a time? Yes. So if you want a little cash flow and you want some equity upside and depreciation, you can put 100 in class A, 100 in class C. You can split it up however you want. You could put, 100 in class A from a cash account, and then, $250K from your IRA in the class B if you're building equity in your IRA. So definitely you can play around different accounts, different classes, however you like. Dan is asking, why don't you pass on any depreciation to class A investors? Shakti, can you take that one?
Just because we treat it like a preferred equity class, and because you're going to be receiving a 1099 INT, we can't give you depreciation. If we're going to be issuing a K1, like in the B's and C's, we can give those share classes depreciation.
There you go. All right. With that, I'm going to move on, and then we can stay later for any Q&A if we don't get to answering all your questions for the rest of the presentation, but I want to make sure we move on. All right, sensitivity analysis. Those of you who love to look at numbers, I encourage you to go back and review this. I do want to point out break-even occupancy. I love seeing this number and asking this number for every deal that we go into. So 71%, what does that mean? That means that we can go down on this property to 71% occupancy and still be okay. It doesn't mean we're going to have a profit, but we won't be in foreclosure. So that's a really important number to look at for each property. And if you're looking to make an investment and you ask what the break-even occupancy is and it's 80, 85, for me, that's getting dangerously high because occupancy has actually been getting down in the mid to low 80s in several markets around the US right now. So you want to make sure you pay attention to that. And 71 is really healthy. So I like that. Anything else you want to say on this side, Shakti?
No, just, for the folks that are looking at this and trying to understand what downside is and upside and base case is what we're presenting to you guys in the return projections. And then what we do in the downside case when we sensitize it is we take all of those things in the downside column into the model. So we say that rent growth is lower than we think it is. Renovation premiums are a little lower than we think it is. Vacancy is higher, stabilized vacancy is higher, so on and so forth. Exit cap rates higher. So we throw all of those assumptions into the model. And then what you see on the class B return is you get a 1.9 equity multiple on the downside. And then on the class C, you get a 1.8 equity multiple on the downside. So all those things happening together on the downside to give the return profile there. And then all the upside things happening together to get you to the upside return profile. And, typically the way these deals work is some of the things in the upside happen, some of the things in the downside happen, and we sort of revert back to the base case. So just for clarity's sake, as you're looking at this slide, I always like to point that out here. Okay. Sarah, you want to say anything before I jump in?
This is a lot of numbers. I encourage you to go back and look at this and understand it if it's of interest to you. But yeah, a lot of people were asking in the chat and I didn't address it at that time. But how can you estimate at the exit that we're going to get, 60% capital gain at the exit or whatever the number is? How can you project that? And this is exactly the answer to that question of how can we predict what your profit will be after year 5. This is it.
Yeah, we work really hard to make that number in the bottom right-hand corner of your screen, the NOI at exit, 3.58 million. We work really, really hard to try to get as accurate as we can on that number. And then, as you guys know, with multifamily, you take that 3.585 million, divide it by an exit cap rate to get to a valuation, a terminal value at the end of the project life cycle. And that's how we can project a 1.92 for the Class Cs and then a 2.02 for the Class B investors.
Yeah, so all the CapEx that's happening, all the interior renovations, we're going to go over the schedule in a second. All the exterior renovations, all of that money that's going in is to raise the quality of the property and then, you know, be able to offer it to the tenants a higher quality community and living experience at an increased rent that then increases the NOI, et cetera, et cetera. So
yeah, and we do a lot of work, guys, on the front end to really understand all the assumptions that go into this. We use axiometrics, we use RealPage, we use CoStar to get rent growth forecasts. We talk to our property tax consultants who's already looked at this property. We look at other properties we own in the Metroplex to see what's happening with rent growth, to see if we can actually achieve these other income drivers. We visit the comps to understand what the competitive set of properties is doing, what they're charging for patio extensions. So we have a lot of data across our 6,000 units that's helping us be informed about a lot of these business plan assumptions that we're making. So we feel really strongly that that 3.5 million is an accurate number. We don't know what the exit cap is going to be when we sell in 5 years. That's why we do a downside and an upside case, but we do feel very strong about getting to that 3.5 of NOI, and it's based on data that we're collecting from our existing assets, the comp set, and then our experts that we consult with.
love it. Thank you. Senior loan, we already covered that, so I'm going to skip it. Location, I'm going to go really quick through this, but if you guys go into the portal, you'll see more detail. But Texas, you can see I own a lot in Texas, and it's the #1 growth state. So during COVID, when everyone was moving around, a lot of people went to U-Haul and the different moving companies. They published data on ingress and egress, and Texas, Dallas in particular, very strong. A lot of people moving there. And then I always say, when you're doing due diligence on a market to invest in, look at the numbers for that market and then compare it to what's going on in the rest of the United States. So it's all relative, right? So you can see that second stat, the 12-month growth rate in Dallas-Fort Worth is 1.3%. And so it's like, okay, there's growth. Is that a lot or a little? Well, compared to the US in general, of growth rate of 0.6%, that's over double. So you like seeing that when you're looking for a market to invest in with real estate. And then job growth as well. If you take a look at those numbers, so 6.7% job growth over the last 3 years in Dallas. Well, is that high or low? Well, we definitely want to see 2% per year growth rate over the last few years in a market that we're going into with a projected 2% or more growth rate in the market. And so Dallas has that, check, yay. But then also, if you compare it to the rest of the US at 3.8%, then you can see it's really strong compared to what's going on in the US in general. Shakti, do you want to say something about, you know, you're in Dallas, you were living outside of Dallas, you came to Dallas to start your company, and you've purchased everything in Dallas. What is your favorite thing about Dallas, and why have you stayed here?
Population growth, job growth. It's #2 and #3. I mean, there's so much being built across the Sun Belt. I mean, it's going to be a record year in 2024 for deliveries. And if you look at a graph, I don't have it here with me today, but and you look at how much inventory is growing in various Sun Belt markets, in Phoenix, in Atlanta, in Austin, in Nashville, you're seeing inventory grow by, in some instances, 10, 15, 20%. If you go to Huntsville, Alabama, they're growing their inventory almost 25%. And you're not going to get the absorption because you don't have the job growth and the population growth in a lot of those markets. So what's going to happen is you're going to see, like you said, Sarah, softening occupancies. You're going to see rent growth declining in some instances. In Phoenix, you have negative rent growth. In Dallas, we're going to be bringing on about 48,000 units in 2024. We're going to be increasing our supply by about 8%, but we're also going to be in need, and our demand side of the equation is going to absorb 50,000 units. So you're going to see a slight softening in 2024, not nearly anywhere else in the country. It's going to soften the least in DFW, and we're going to bounce back in 2025 faster than any other market. And that's why Marcus and Millichap and CBRE have ranked Dallas as their #1 multifamily investment market for 2024.
Awesome. I'm so excited. Cool. So McKinney is northeast of Dallas Center. You can see the star in the upper right-hand corner, West Creek Ranch. So it's not quite in the center. So do want to point out there's a lot more data in the investor data room for you around the market. But I do want to point out that there are a lot of strong jobs, like Shakti was talking about. You want to make sure there's a lot of great jobs where you have inventory, and also where you're making the inventory better to make sure that the jobs are aligned, that they're good jobs, that they're high paying jobs. And so the tenants can support and want nicer units to live in. So that's what this slide is depicting. And I really love this. This is so important, especially when your units are designed to have new families in them. The school district is super important, and it's an A. So we like that. We kind of touched on these. This is looking at the gym, by the way, on the property. Stack that in there. All right, value add business plan. I'm looking at the timeline of today. We have 7 minutes left. So what I'm going to do is I'm going to go through this kind of quickly and point out what I think is really important for you guys to go back and really understand. But this is the plan over. You can see the first box. It says months 2 to 8. The second is months 4 to 12. So you can see when different things are planning to happen. But what I think is really cool is this chart. So Shakti talked about in the beginning being vertically integrated. So take a look at this. Month number 3. What happens at month number 3? Occupied units renovated. Look at month 3, 4, and 5. They have a number in there, and starting at month 6, there's no more numbers. But Shakti, does that mean all of the apartments are going to be renovated within 3 months, and then rent will be able to be raised to the rent premium by August of 2024?
Half of what you said is true. The other half is partially true. Okay. So the first answer to your question is that is another one of our competitive advantages versus our competitors. We do something called interior occupied renovations. So we go in at 8 a.m. and the tenant can either stay in their apartment or go to work, but we'll do a full renovation except for flooring and paint while they're living there. So new cabinets, new countertops, new stainless steel appliances, bathroom vanities. So we do the full renovation, and we can get through 2 units a day in the first week, and then we can crank up to about 4 units a day in the second week. So last year, just to put it into perspective for you guys, we did 2,400 interior renovations that were occupied across our portfolio. And the way it works is they get to stay in their lease at the existing rate until their renewal. And then when they renew is when they get that $200, $190 renovation premium. So within about 6 months of starting the renovation, 6 to 9 months really, we can get all 226 units through the rent roll to see that $516,000 annual premium.
Yeah, so I think that's really good to point out, because a lot of people think, oh, 190 per door, does that make such a big difference? It makes $500K difference per year, and then you multiply that out, it makes a big difference. Yeah. And Stacy, I know this is one of the things that you really love about Ashland Green, because we've all been in projects where, like, here's the interior renovation plan, it's 2 years long, and not saying that that's a bad model at all, but a lot of you are in those types of deals, and I am as well, and they're perfectly fine. But what it means is it takes 2 years until you can maximize your net operating income, as opposed to within 1 year when you do it this way.
It's huge, I have to say. And Shakti, I don't know if you have the video available. I think it would be so neat to show everybody the renovation, that little time-lapse renovation. Mm-hmm. They do it in the same day, in 1 day.
Yeah.
Like, would you come and do my house, please?
Well, so one of the things with that, right, is that we can't get too cute and creative. We usually have like a standard diamond renovation scope. So we kind of, it's like a printing press. It's the same exact thing. It's like, stamp it, press it, move to the next one. So we can't do like a lot of bespoke type of renovation. So when we do choose a new product that's going into like some of our nicer units, like we choose blue cabinets at one of our renovations last year. And we really had to spend an extra like month to kind of get that into our logistics sort of life cycle. And we can't do a lot of changes. So Stacy, if you want us to do your house, it'll look like all of our other diamond renovations, which is great, but we can't take any custom requests. Sorry.
Oh, so I do see people saying they would like to see the video. So
Okay,
Stacy,
we'll send it to you and you
yeah,
can send it out to them, Sarah. That's a great
yeah,
idea.
we'll put it in the data room.
Okay.
And someone's saying, wait, I'm confused. What is the number of units? So there are 240 units in the property, but as Shakti said, some of them have already been renovated. So 226 are the number of units left to be renovated, correct?
Yeah, and the 14 units that already have been renovated is that picture you saw Stacy and Sarah in that looked all pretty, right? So
Yeah.
we're just going to do that same exact scope, very similar scope in our 226 remaining.
Yeah. All right. So there's community exterior CapEx stuff that's going to happen as well to add to the value creation. And here's some of the items, and we can go back to them, but I do want to get to the next step. So we spent way too long. So I'm gonna just show you guys rent comps are in here, so you can go through them, be thorough in your due diligence, make sure you take a look at everything. All the information is here. Sales comps. So I want to point out one. So this was really impressive to me. So when I went out there and looked at the properties, so the one on the right is West Creek Ranch, the property we've been talking about. And it's got lights and it's warm feeling, even though it was a cold day, but you can see the atmosphere is really warm. And then the Rustic, which is on the left-hand side, this is a property that is really close. It was like less than 3 miles away. And it just sold in, I think it was December, so 3 months ago. And it sold for 216,000 per unit. And then the one we're buying is 187,000 per unit. So that's a 30K per unit difference. And that's, to me, I was like, wow. West Creek Ranch is definitely a nicer feel inside and out than the Rustic. And so the fact that it just sold a couple months ago at 30K per door higher I love it. And that's not even the biggest differentiator. So if you look at the sales comp page, on average, it's about 60K per unit below other market comps. But that one is like really close and just happened. So I think that's a really strong comp to let us know the purchase price is awesome for this. All right, investor next steps and the accreditation process. So if you guys go to investwithsarah.com, that's how you begin. So Shakti was talking about his tennis game. So back in February 13th is when the PSA was signed, way long time ago. We're moving quickly on this one. I'm being sarcastic. So due diligence is not complete, right, Shakti? It's supposed to be in the next day or two. It'll be complete. Is that correct?
Yep, we start tomorrow. Should be wrapped up by Wednesday, Thursday.
Cool. All right. And then today, February 19th, is the subscription in the data room. It's all up there as of this morning. It's all been tested. So if you guys are interested, go to investwithsarah.com and everything is ready to go. And I'm going to show you, I'm going to share my screen so I can show it to you. But I want to let you know the rest of the timeline. So March 8th is the funding deadline to receive a bonus. So it's a 5% bonus. Shakti, could you explain this? Because I think it's really important for investors to understand what that March 8th date is.
Yeah, so what we're basically trying to do is incentivize folks to get their dollars wired by March 8th. So we'll be holding your money for about 30 days. And we know that the opportunity cost of us holding your money is that you can't generate interest on it in a money market, or maybe you want to put it in the stock market and you can get some appreciation there. So what we're doing on this deal, which is a little unique, is we're going to give investors a bonus of 5%. So if you put in $100,000, you're going to get effectively another month at 5%. So call it, if you put in 100 grand, you would get an annualized 5%, which is about 5,000. You divide that by 12. So you'll get an extra month of distribution. So the deal is not going to be seeing cash on cash if you're a B and C investor for the first 2 years. But if you do fund early, we're going to give you guys a 5% bonus.
That's pretty generous. Don't need to do that. I think that's really nice. Very creative. I've never seen anyone give that as a bonus, so that's really cool to see. And then what to expect after you invest. So target to close in April, take over the property, and then everything will be in Juniper Square, you guys. So you'll see the data, you'll sign, you'll wire, everything will be in Juniper Square. So you can log in, and every month the financials will be there. Every quarter there's a webinar. You'll get emails with all of this information, but also you'll be able to log into your portal and access it all. And then this is really key. April 10th, K1's delivered to investors. So I think that's, it's pretty unique in this space to have K1s out by April 10th. So I think it's great that let everyone know that that's the track record of when you guys deliver. And for all my properties that I have with Ashland Green, that's also been my experience. So next slide. We introduced Stacy at the beginning, but for those of you who jumped on, Stacy is the person that you will most likely be talking to as you're going through the subscription process. So we are going to do, because there are so many of you, we're going to do every Thursday, we're going to do an open Q&A. So if we don't get to all of your questions right now, or if you go into the portal and you're looking at stuff and you have some more questions you come up with, you can come to the open Q&A every Thursday and ask Stacy your questions. She'll be there. Sometimes I'll be there as well, but Stacy will always be there. So again, what's the process? You go to investwithsarah.com and you sign up. So I'm going to stop sharing my screen and show you what it looks like. I'm going to go into the portal and show you, so you know what is investwithsarah.com? Where does that take you? What do I do with that? Okay. Investwithsarah.com will bring you, oops, I lost my share screen button. There we go. That'll bring you to this page. And so you simply put in your name and your email address, and this is non-binding. You put how much are you interested in investing? Are you an accredited investor? This is a 506C for accredited investors only. And then how would you like to invest? So some people are asking, I want to use my self-directed IRA, and this is where you just let us know. And you can change this later, but this helps us know. So we're going to send you instructions. If it's the first time you've invested with your self-directed IRA, what does that look like? So it's just so that we know what you're looking to do, but you can change that later. And then we will give you access to the data room. So this is what it looks like. It has all the details we were just talking about. A lot more information below here, some Q&A down here at the bottom. And then I'm going to scroll back up and show you, because a lot of people look through this and they go, wait, but where's all the documents? So it's kind of small, but you see this right under value add, viewing data room for Sarah Sullivan, overview documents. So if you click on documents, that's where you'll see the full investor deck is right in the middle. So that's the full 65 slides. So if some of the stuff we went through quickly, you can go back and look in detail here. Then there's a one-pager with the highlights, one-pager explaining the investor returns, and then the next steps. What does the process look like? So once you're in here, you see this green button that says subscribe. Once you've done all your due diligence and you're ready to go, you click subscribe. And then you just start filling it out. So if you want to, well, I'm not logged in, so it's not letting me do it. But you would start subscription, and then you can select, hey, I'm going to use my name, or I'm going to add a new account and use my IRA, whatever that might be. All right, so that's the end of the presentation. Oh, some people were saying they couldn't see that. Could you guys see the screen as I was showing the links? Okay, so it might have just been that person. Okay, so now we can, I'm going to start reading the chats and the Q&A and going through them. Shakti, before we do that, is there anything that you want to say about this property that we didn't get to that you think is really important for investors to understand?
No, I think we covered quite a bit. Happy to hit
Alright.
the Q&A with you.
Okay, Stacy, anything you want to say about it before Q&A?
No, a few questions. I see a few people asking, hey, can you show this tab again? It's
Oh.
all in the portal. So if you go through the portal, we can go back and show the loan. You can see the loan information tab there. So great question, but I would say all of the information that you're looking for is on the portal.
Yeah. So this full investor deck, you'll be able to access it. I'm logged in kind of funky right now, so it doesn't show up, but if you click it, once you're logged in as you, then you can access it. All right, let's see. Oh, what does it mean to enter into the PSA? That means the purchase and sale agreement. So basically when we got it under contract. Basically when Ashley Green got it under contract. If there's a deadline later than March 8th for wiring funds, which would not have the bonus, yeah, so if we're acquiring it in April, it has to be in before April, and we'll kind of see where we're at, see how much money we have in by the 8th. If everything's not in by then and you want to invest, you would be welcome to invest. Let's see. I like this. Impressive would be an understatement. Thanks, Brady. How does investing through a trust affect the bonus depreciation? I don't know the answer to that. Shakti, do you know?
No, can't take it. That's above my pay grade.
Okay.
Yeah, I think that's an ask a CPA question. With the trust, yeah, because I think it's going to depend. Is it a trust, a pass-through trust, or is it a irrevocable trust? Is the trust qualifying as an accredited investor with the 5 million? Maybe the trust gets it. I would ask a CPA.
And I know the answer, but I'll let you take this one, Shakti. What are the fees for the general partners?
So it's a 3% property management fee, 3% acquisition fee, 1.5% asset management fee.
And that's pretty right in mid-range of what you guys will see out there with different syndications.
Yep, pretty common from the deals I've seen.
Yeah.
And I did see somebody was saying April 10th, isn't that kind of late for K1 since taxes are due April 15th? No, that is really, really early. As investors, those of us who have invested in alternative assets, we're used to filing an extension. I can't remember ever filing in April. I file an extension every year. And I've had so many syndication operators that get us the K1s in September, October, August maybe is good. Ashley Green doing April is amazing. I'm really excited. I'm happy about that.
Yeah, that makes our job easier. All right, Brady, this is a great question. Is SuGo Capital getting any fees for raising the capital, or is capital going directly into the partnership? The capital is going directly into the partnership. So when it comes time, this is a really good question, Brady. When it comes time to wire, you do not wire the money to SuGo Capital. You wire your money directly to the account for the entity for the investment. And your investment amount does not go down by a fee amount to SuGo Capital. So the fees that were talked about, that Shakti just talked about for the GP, I participate at that level, but I don't touch your capital. It goes straight to the investment. Hope that helps.
And to be clear, Brady, all those LP returns for the Bs and Cs are all net of fees as well.
Mm-hmm. Yeah. All right, this is a good one, Kenneth. We didn't go over this. So can we talk about insurance? Is the property going to be adequately insured for fire, flooding, hurricanes, etc.?
Yeah, so the lender has certain thresholds that they basically obligate us to in terms of what is covered. So yeah, flood, fire, hail, all of those things are required. The only thing that we get to select, and this is across our entire portfolio because we have a master insurance policy, so we get beneficial pricing, is what is our deductible going to be? Is it going to be 100,000? Is it going to be 200,000? Is it going to be 300,000? We'd like to keep the deductible on a portfolio basis less than $500,000.
So this is a very important question. PR is saying, hey, are the GPs ready to put money into the deal if 2 years from now it's not going the way it was planned? I'm seeing a lot of capital calls right now. So basically, what kind of insurance do investors have that they won't experience a capital call?
All I can do is reference our track record, which is we have not done a capital call ever. Never missed a mortgage payment. It's certainly a challenging time right now, but we're being creative and doing all the things that we possibly can with our lenders to not have a capital call. So trying to keep that track record intact. So there's no guarantees, but as it relates to what we've historically done and what we're doing now, we don't have any capital calls.
And I'd like to add that, I have a lot of partnerships outside of Ashland Green, and in those other partnerships, we have put in our own capital in order to avoid a capital call to investors up until a certain point, right? And so we've only done one capital call so far, and it was 2% of what was invested, so it's pretty low. But we did have to do one. But I say that to demonstrate that the kind of companies and people and individuals that I partner with, that SuGo Capital partners with, are folks that have that same investor first mindset, because nobody likes capital call, but there are ways to be creative to avoid it. And one of the biggest things is buy right, which we've done with this property. Be conservative in your underwriting, which Ashland Green has done with this property, and with debt and all that kind of stuff. So I hope that helps. But it's a really good question because a lot of people are experiencing that right now.
I think it's a good time to, my Warren Buffett quote always comes to mind. The whole be fearful when others are greedy and greedy when others are fearful. I do see a lot of people fearful because they've seen the capital calls, they've seen what's going on. And unquestionably, there are a lot of syndications that are failing right now. And for us, it's a fire sale. It's like, okay, we're going to have some great opportunities. But as you know, it's like, no, the time you should have been fearful was 2022. But now this is a really great time. I think there's going to be some amazing opportunities.
Definitely. Thank you for that, Stacey. I see another question. We kind of answered it, but I'll hit on it again. And this is from David. So he said, so Ashland Green is GP. What is SuGo Capital? And is there a percent cut? So no. So SuGo Capital and Ashland Green are co-GP on this deal. And so I don't take any cut or fees of investor money that goes in. Your money goes straight into the deal. And then Ashland Green and SuGo Capital are co-GPs on this property. Leah is asking, is there a disposition fee to the sponsor? Yes, there is. Shakti, do you want to say what it was again?
1%.
1%. And yes, the recording will be sent out later today. You will not be able to 1031 exchange into this property, but we're hoping to structure the next property so that you'll be able to. Really hoping to be able to do that because I know that there's a lot of folks who are exiting their single families or things that they hold, and they're looking to move from being an active investor to a passive investor. And so we're looking to structure the properties going forward so that we can enable this for you guys.
Yep. So later this year. And Cash is asking, I think when you're asking for a negative K1, you're asking about bonus depreciation. So pre-legislation changing, what are we expecting for bonus depreciation?
So 50 to 55%.
Yeah.
Yeah. 50 to 55% of your investment in year one. All right, looks like we might have gotten all the questions, you guys. Oh, that was all in the chat. Let me go to the Q&A. Can I have the link to the deck? Yep, you go to investwithsarah.com, put in your name and email, and you'll get a link to the deck. Yes, you can use your self-directed IRA.
Let me take this one about 1, 2, and 3 bedrooms from Michael.
Oh yeah, go for it.
So this is almost, I want to say 70% 2 and 3 beds, which we love, 865 square foot average unit size. So we like that, especially in an area where you have A schools like McKinney. great for growing families that want to be in 2 bedrooms and 3 bedrooms, maybe have 1 or 2 school-age children, so they're moving there to take advantage of the school districts. And somebody mentioned, how are you guys looking at supply? And it's a great question. A lot of supply coming on. Luckily, we have a lot of absorption, and McKinney's grown 320% over the last 20 years. And so in the first 2 years, we're underwriting a little bit of a softer occupancy. So it's why you don't see a ton of rent growth and why you're seeing 0% cash on cash for year 1 and year 2. But we expect in years 3 through 5 for occupancy and rent growth to firm up. And that's when you guys will start receiving your distributions.
Love it. And then I think 2 more questions before we wrap up. One is how confident are you at the 5-year exit? And what if it's not a good time to exit at 5 years? What would you do?
Well, we want to get to the refi. That's kind of the first major capital event. And I think there was a question about, is there going to be a distribution at the time? Our first goal is to refinance out the $37 million. And then we can decide if there's going to be a distribution, if we want to pay off the preferred equity, which is you guys as well, and then just keep the LP equity in. The nice thing about using an agency loan is that we can always do an agency loan in 3 years, and then maybe at 1 or 2 years down the road, do a supplemental if we want to keep it, or if we want to exit in year 5 and stick with the business plan, we can exit it. But that's something that we discuss on a regular basis with you guys on these quarterly webinars. You guys, some of you have been on them, some of you have not, but we go through the entire portfolio. It usually takes anywhere from 90 to 120 minutes, and we do it once every quarter, and we go through the plan for each asset by asset. So even if you're not in our other 20 deals and you're just investing in West Creek Ranch, you'll see what our plan is with West Creek Ranch. You can post your comments, we'll respond to them, and then you can see what's going on with the other 20 assets in the portfolio. But generally, if people want to stay in the deal, which in a location like McKinney, we could refinance and we could sell, we could put a supplemental. We just don't know what's going to happen in 5 years, but we keep as many options and doors open as we can so we can take advantage of what's best for the investors at the time.
Love it. I love that any investor can see any other investment that you have. It's very transparent. Love it. Can you explain the rate cap is what someone is asking?
Yeah, so rate cap is whenever you take a floating rate loan, you have a spread over an index. Hope I don't confuse people too much here, Sarah. But basically what a rate cap do is it allows you to synthetically fix your rate for a certain amount of time. And so we like to do that for anywhere from 2 to 3 years. So we can take advantage of the bridge loan, which gives us more proceeds, but then we take a floating rate loan, but we cap it at a 1% above the index. So the index rate is SOFR, and we have a 350 basis point spread over SOFR, and a 1% cap will allow us to artificially synthetically fix our rate at 4.5% for the next 2 years until we buy the next one, or if we decide to refi.
Cool. Thank you for that. All right. Well, I think we're good. We'll wrap it up. If you guys go in and review the material and you have additional questions that you come up with later, Stacy will see you Thursday, 1 p.m. Pacific. I'll send out a link to sign up for that. So if you have any additional questions you come up with later, we'll make sure and get those answered for you. With that, I'll say, I think this property is like the coolest thing about it is its structure. The deferred maintenance is like, where? I don't see any. It was such a strong bones complex when I went there. It feels so, to me, it just feels so secure as a place to put your money that there's not going to be any surprises about, stuff falling apart. It just a really, really great bones property in a really, really great location. And the team is being really generous with the preferred return and everything like that. So thank you, Shakti. I'm really looking forward to partnering on this for the next 5 years with you guys. I know it's going to be great. Any final words you'd like to say?
No, I wanted to thank you for putting a pretty amazing webinar together, and thank all the investors for joining on President's Day. I know everyone's busy, but to see, several hundreds of investors come out, I think you guys are really smart to be, watching multifamily this year, as Stacy said, what Warren Buffett said, when, the time to be greedy is when other people are fearful, and the time to be fearful is when other people are greedy. And Stacy, you're spot on. We should have been fearful in 2022, and now is the time, to get involved. And I started in 2008 after, the great financial crisis in the summer of 2008, and I bought one property in 2010, and really that property is what fueled growth to buy in 2012 and 2014, 15, 16. And I guess my one regret after the great financial crisis was not being able to purchase more. So this year we're planning on buying maybe 10 to 12 deals, and this is the first one of the year, starting nice and early. So we're definitely going to be greedy this year on the buy side.
Stacy, any parting words you want to say about your thoughts on this?
No, I love this investment. So from an investment standpoint, I think this is going to be it's such a pretty building too. It's the nicest one I've seen you have ever. Just really beautiful building. It's a fun investment. This is a great year to get into multifamily. For those of you who know me, I went with Sarah because the apartments that I had, even managing the property manager, was a lot of work. But luckily we have Shakti and Sarah and the whole crew doing all of that. So you and I get to be passive investors. So, and as an investor, I've been down the road everybody has of, oh my goodness, using my SDIRA, I didn't even know that was a thing. How do I do that? So I look forward to helping all of you too, as even if it's not your first rodeo, you might have problems with our platform. Maybe you need some help walking through the process. Happy to help with that. If you've never invested in alternative assets before or never invested with your IRA, I look forward to helping you. Just hop on the call on Thursday. We can walk through the portal and everything, answer all of your questions.
Awesome. Thank you for the great support that you give all of our investors, Stacy. All right, everybody, with that, I'll say have a great Monday and President's Day. Hope you're all doing something fun with the rest of your day. And we will see you next time. All right. Bye, everyone.
Bye.
Bye.
Bye.